Welcome. My name's Paul Mitchell and I lead the Global Mining and Metals team here at EY. It's great to be with you today, and I'm joined by Mark Barnaba. So Mark's a Senior Director in Australia. He's a board member at the Reserve Bank of Australia and is the Senior Independent Director at FMG, who released some fantastic results last week. Continuing to push ahead and are obviously making big investments into hydrogen. We probably won't have time to talk about that today, but it's been some exciting times ahead. What we're going to talk about today is our upcoming Top 10 Risk and Opportunity Report. It's obviously the risks and opportunities that the sector will be facing in 2023. But today we're going to talk about what the risks have been over the last 15 years. So this is the 15th time we've released this report, and we thought it was a good time to reflect, think about the way the risks have evolved over that period of time, and then ask Mark, who's obviously got a much broader background, great economic knowledge, has just been to a meeting of the Reserve Bank today, so we'll have a great economic update on what's happening globally, what he thinks are the megatrends that are going to influence the risk list this year. So Mark will give us some idea of those, and we'll talk about the impact of those on the mining and metals sector. So before I ask Mark to talk about those, I just thought we'd reflect a little bit on the risks and opportunities over the last 15 years. It's been interesting sort of looking back at what those risks were. So if you sort of think back to when we first started this, 2007, prices were in decline, the industry was going through consolidation. It was quite different to how it is today, and the risks reflected that. So they reflected the fact that prices were in decline. There were issues around there like cost reduction. We were still allowed to use that word in those days. There were issues around capital and how we allocated capital. And there were issues just around the way that the industry should be continuing to grow. We then obviously entered the super cycle, and the risk list changed quite significantly. Super cycle was a big time for us all, but we brought in really interesting other factors. It brought in resource nationalism, so government sort of suddenly said, hey, we've got all these companies making a fortune out of the mining industry, how do we get a share of that? It became really difficult to recruit people. I remember the headlines at the time of truck drivers making $250,000 and houses costing $1 million in the Pilbara, and issues around tightening economy and inflation and how those things could sort of work. We then went back into a little bit of a decline, but the risks changed. It was interesting. I was talking to the team the other day. We actually looked at cancelling the report around that time, so we're thinking, oh, here we go with another cycle of risks, and we'll have one set for good times and one set for bad times, and really not tell anything different. But 2017 things started to change with the 10th year of our report. Digital came in big. Digital was our top risk. We thought that was going to disrupt the industry. We thought, who's going to be the Kodak of the mining industry, or who's going to be the Uber was the question we used to all get. Who's going to be the new one that's going to go through? Didn't really disrupt the mining industry that much, certainly not at first. But as time's gone on, in the last few years in particular, we've seen the emergence of social issues. And they're what's really been disrupting the industry. And so we've started to see new business models emerge. We've started to see ESG at the top of the list. In fact, social issues were our top 3 risks last year, really dominated the list. We debated whether we should consolidate them, but they were just so significantly ahead we wanted to do it. And when you mix those ESG and social factors with digital, we started to see disruption. So we started to see changes in portfolio, we started to see real different changes in risk appetites and differences between countries. We saw nationalisation of assets, and things really started to change. Obviously the last year has been another big year of change. We've had some pretty big things happen around the world, and that was why we thought we'd get Mark in to talk to us about some of those big changes and just, what do you think are going to be the big megatrends that are going to impact us this year, Mark?
Well, thank you, Paul. Lovely being here. Congratulations on the risk report. It's a really good look back on what the recent history in the mining industry has been. Congratulations also on your own personal leadership for the mining business here at EY, and more generally just for being a leader in the mining industry, full stop. So what are the major risks going forward? Having a crystal ball is always a lovely thing, but I see four, and they will show themselves, I think, in various guises. Let me just mention the four, and then we can actually maybe discuss each one in turn. The four I see are China, inflation, rearmament more generally, and the pace of electrification and greenification globally. On China, a lot has been said. It's especially in Australia, a commodities industry and country, an important topic of conversation, but there are two separate, I think, issues with China in terms of risk. The first is just the rate of growth of the Chinese economy and the extent to which that is starting to slow. The second is a geopolitical issue, so let's just separate those. Look, on the first, a combination of natural slowdown in, I think, consumption in China, a zero COVID policy, which has meant that only recently two major cities, and these are cities of populations of nearly 20 million people each, have virtually shut down. If you have a look at steel production, it's really come off in the last 3 months. That's had an impact on iron ore prices. And obviously what we're seeing in the property industry, and the property industry is a major driver of GDP in China, so it has a disproportionate effect, much more than it would have, for example, in many other Western countries. So one issue is simply a slowdown in, for many factors, the Chinese economy, and for commodities, regardless of which country you're in, that will have an impact. And we're seeing that. We're seeing it in commodities that are necessary for steel, and I think we'll continue to see that. The other is the geopolitics, and forget whose side you're on or how you perceive it, just this decoupling of the supply chains. I mean, China is becoming, by design, much more standalone and independent, as is the United States. And, it is in many cases a classic case of the prisoner's dilemma. When you have two parties that don't have full trust in each other, they take independent decisions that for themselves make most sense, but overall are the worst possible outcome for everyone else combined. And if we do have a continued decoupling, it will mean a less open trading environment, and that should concern us all. So interested in getting your thoughts, but I still think for the commodities industry that China basically is for both reasons, probably the greatest risk that you can see emerging. It's still there, but emerging in a different way over the next 12 to 18 months.
Yeah, no, I think that's in line. I think energy transition and the infrastructure required for that, which obviously you'll talk about in point 4, I think is maintaining good prices, but they're not great like they were. What do you think's the trigger for China reopening from COVID? And is it the Congress meeting in October, or do you think it'll be a bit longer?
Well, that's a very good question. So the Congress meeting is an important meeting. It is likely to result in, very likely to result in, Xi Jinping getting a third term. One would like to think that then restores China being somewhat more open, because right now it is closed. If you're a Chinese national leaving, you have to quarantine when you come back in, and as a foreigner, finding a way in is just terribly hard at this point in time. It would just be good for that to change. I'm hoping that with the passage of time, that's exactly what occurs, and that is the trigger.
Yeah.
So if we put that one aside, and I think the reopening is a wonderful way to frame it, the second cloud on the horizon, and it's known to us all, but it can morph its way in ways that I think we haven't yet thought through, is inflation and monetary policy. Financial markets have an impact in the real economy and in real world investment. So right now, I think the world is hopeful that in many countries there will be a soft landing associated with the current tightening of monetary policy. Keep in mind that monetary policy is tightening, but in most countries it's either at or still below the neutral rate. Yep. On that being the case, it is still expansionary, not as expansionary as it was before the tightening occurred, but it's still for many either neutral or slightly expansionary. But for the mining industry, one of the big impacts is if you add 3 or 4% to your weighted average cost of capital. In boardrooms, all of a sudden you're looking at investments that there's a big upfront capex. That's how it works for us, as you all know, with a long tail of free cash flow that you have to discount back. The increase in interest rate has no bearing on the negative capex, but has a very big bearing on those positive cash flows 5, 10, 15 years out. And so you do start looking at them through a different lens, and it can have a 20, 30% movement in the attractiveness of a project. So, that is an impact. We're not an industry where you can hedge necessarily that easily. Pick which one you want. Even gold, but iron ore, there's a bit of hedging in the market, but you can't hedge that much. So you can only take out some of the volatility so quickly. So if you've got, increasing interest rates, increasing discount rates, it looks like it could be there for a while. Cost of living pressures, reduced aggregate demand, and increased volatility, that combined is a risk which virtually every board, every CEO, every senior executive, every CFO has to think about how they deal with, and that will have an impact.
I like to think we're probably a better place to deal with something like that, given that balance sheets are in a much better position.
Yeah.
But yeah, absolutely, it's that's one that's going to bite, and one that we often think as it's one of those megatrends. It's one we often think about talking about it specifically. But it's a great one to bring up because it's something to keep in mind.
I like how you said we can still mention the word cost reduction. We can, and what it usually does mean is that if you have that environment, commodity prices come down somewhat, the focus changes from being just growth to, call it transformation, call it cost reduction, but it does subtly change to that refocus, which may not be a bad thing, by the way, Paul, because we have had a period of unfettered, at least in the mining industry, growth, especially in specialty metals and base metals. So the time may be right.
Yeah, great.
The third risk is an odd one, but an important one, and you helped me, which I'm grateful for, I think, frame it correctly, and that is the term rearmament. And I use the term rearmament simply observing what's happening in the world. And what's happening in the world is that with the war that is happening in Ukraine with Russia, that has caused a lot of countries that had a lower spend in terms of defence spending for GDP per capita basis to really up that. Germany, Japan being two good examples. And you only have to take 4 or 5 countries, those two included, and look at the increase in GDP spend from, say, 1 to 2% of GDP annually, and you can easily find around 200 billion US in additional spend, additional incremental spend on rearmament. Now, let's think about that. I mean, the risk is you don't rearm unless there's a threat of, or an increased threat of, instability across the world. So the negative and the risk is that actually eventuates as something even broader and more encompassing than just Ukraine, Russia. Not that that is small or unimportant. Yeah. Not at all. We understand how fundamentally heartbreaking that is, for both Russian and Ukrainians. But if it does lead to something which is, encompasses more of the world, then the impacts of that are ubiquitous. Yeah. The flip is, if it doesn't happen, I mean, you've got 200 billion annually, pick a number, that involves production and manufacturing of a lot of things that need commodities, because you'll need a lot of steel, specialty metals, specialty steels, batteries. You've got cobalt, nickel, lithium, copper. The flip is, you don't need 200 billion extra for many years to see that could lead to maybe not a super cycle, but certainly a period of strong, encouraging commodity prices for quite a period of time. So it is both, like all of these things, a risk and an opportunity. China may decouple less and its growth may be stronger. Yeah. And there's a big incentive for that to happen. So that can go from being a risk to being a positive. We know there's inflation. We know what's happening with monetary policy. It may be less aggressive than we think. It may taper off more quickly, and that actually, compared to where we think we are today, could be a positive. Rearmament could end up being a net positive, but the flip is, framed the way you and I talked about it, it could still be a risk.
Yeah, absolutely. I think it's quite interesting. One of the other things we've noticed in the last couple of years of our risk report is the linkages and the synergies between the different risks. And I think, when I think of rearmament, the acceleration that's had in terms of people starting to think about greening and electrification in Germany, France, Western Europe, that's been so dependent on Russian gas, has just been incredible. It's probably a good segue to your last point.
Well, keep the last till best. It's certainly not the least. I do think one of the risks that we know is on the horizon, and it framed as a risk, but it's also an opportunity, is just the rate of change in the way the world sees, produces, and understands energy. And there's an argument to be mounted that, to the extent that the last 30, 40 years have been about the fundamental impact of technology on the world, from individual computers to the strength of supercomputers to Blackberries and iPhones to the use of the internet to social media, then the next 20 years it could be that energy is pretty much that story. The growth of renewable energies as either the major or even more material energy source, the combination of those, especially, I think, wind, solar and hydrogen, though hydrogen is an outcome of also wind and solar, coupled with storage as a baseload solution. But you have a look at where both of those are going, so much money and capital and thought from technology to infrastructure are going in to green solutions, green energy, renewables, electrification, more broadly, whether it's battery technology, whether it's battery management systems, whether it's alternatives for the production of hydrogen, green iron ore, that there will be a tipping point, I think, soon, and there will just be a fundamental nature in how the world uses and positions itself. This was an issue 12, 24 months ago, but there is no doubt that what you mentioned, which is, go to France, Italy and Germany and just understand the UK, how those countries that were dependent on Russian oil and gas fundamentally now understand that they need to take energy security into their own hands for good reason. For good reason. And that will accelerate the rate of change in greenification, electrification, renewables, purely due to the weight of demand and the weight of capital. And I think it'll occur at a rate which we're not yet prepared for. I always look at, when new technologies come out, the predictions of the EYs, the BCGs, the McKinseys. EV technology 10 years ago was a very good one. How quickly will it occur? And my observation has always been that because it's usually singing from your own book, you are more optimistic than often is the case. Electric vehicles is a great example of where the most optimistic estimates 7 or 8 years ago have been completely knocked out of the water, and it's occurred much more rapidly. Scandinavia is a great example, Paul. So, and we're seeing it in other countries. So, how do you become more granular on that discussion? That is a much longer discussion. It would take you and I a lot of time to build it out. But from where you and I sit in the industry that we operate in, it is replete with opportunity and risk, because I think if you don't move quickly, mines will have to decarbonise. Boards will have to really pay attention to this, or they'll get 2 strikes in certain companies and not have a governance licence, let alone a social licence. So there are a lot of issues wrapped up in here. On one hand, opportunity. On the other hand, screaming big risk, which has to be managed.
Absolutely. Great. Thanks, Mark. It was great to get those insights. We'll reflect on those as we finalise our list. Before I sort of finish, I just want to thank you for coming along. It's really interesting watching the journey that FMG and FFI are on. I was in Canada last week, and Fortescue was described as the corporate world's greatest proponent of hydrogen. I thought we just don't sing that enough here, so I thought I'd repeat what I heard there, because I think sometimes we sort of ignore our homegrown successes here in Australia.
Paul. Thank you, and I really enjoyed being here today with you, and I appreciated the opportunity, so thank you.
Thanks everyone, and the report will be out at the end of September, so look forward to feedback. Thank you to those that completed the survey, and we'll have another webcast when we do the launch at the end of the month. Thanks everyone.